time the market is like trying to predict when the next big fire is coming. You can't do it. Dollar cost averaging is a great way to remove the emotional side of you from investing and start investing automatically to really build long-term wealth. Today, we'll talk about dollar cost averaging, how it actually works, how to do it yourself to protect yourself from emotional investing, and how it'll build long-term wealth for you. Many investors get into trouble through investing for the same types of reasons. It's really hard for us to separate our logical side from our emotional side, particularly when money is concerned. So many people make mistakes in the market when they do several things based on their emotions. Let's say they try to time the market because they're scared about missing the right time to invest. They typically miss out on the investments. If you get scared when everybody's selling and then you sell, then you're missing out and you're losing. If you aren't investing when things are high, you may be missing out because maybe things go higher after that. Dollar cost averaging removes all of that from you. It basically allows you to purchase things consistently over a period of time without timing everything. And by doing that automatically over a long term, you'll end up being much better off than you will missing out on a lot of those benefits. What is dollar cost averaging? So dollar cost averaging is basically purchasing the same value or the same amount of money over a regular period of time. So let's say every paycheck, every month, you invest $200 or $500 or a percentage of your overtime consistently over that period of time, instead of trying to wait with a chunk of money to buy something at the exact perfect time. If you dollar cost average and you're purchasing things consistently, either every 2 weeks or every month, you will have a much more consistent track history of doing it. So when you dollar cost average, you're basically removing the emotional component of it. If you're investing $200 a month and you're buying a certain amount of ETFs or dividend stocks, for example, those are going to give you more during times when things are cheaper, when you're buying them at a discount when the market's down, and you're going to buy slightly less when the market's up and you're buying them at a slightly inflated price. But the advantage of it is that you are consistently buying these over the long period of time. Let's go through a 5-step action plan for dollar cost averaging. Number 1, pick your DCA schedule. So for this, determine what it's going to be for you. Is it every paycheck on payday Friday? Is it once a month? Determine what the schedule is for you. Determine the amount that you're going to do. Say it's $200 a check or $500 a check or a percentage of your overtime. Determine what those two things are, and then automatically transfer that money from your account that same time, either every 2 weeks or every month, into your brokerage account. Then go into your brokerage and have it set up to automatically purchase whatever that stock or ETF is that you have set up for you. Let's say it's an S&P 500 index fund or a mutual fund for the S&P 500. Set that up automatically to purchase it that same day or maybe the next day to give it a little bit of grace period for that money to transfer in. And then by doing so, you won't even have to think about it, and that'll automatically build over time. The main key to dollar cost averaging is that consistency beats timing every time. Number 2, choose the investment that you're going to make. So if it's an S&P 500 index fund or it's a REIT or it's a dividend stock, decide what those different investments are that you have and set those up automatically to purchase after the transfers have gone in there from your bank account. Number 3, automate it so you don't mess it up. So if this is in your 457 or if it's in your Roth or if it's in an individual brokerage account, automatically set up whatever those purchases are for the different type of investment you plan on making and correspond it with the timing of that money transferring in. Once you have the dollar cost averaging set up, don't touch it. The only exception I would say to make this is if you end up increasing the amount of investments that you're doing. Otherwise, you're just changing the amount that you're investing in there, really not even the timing part of it. Number 4 in this action plan is knowing what dollar cost averaging is protecting you from. And really it's protecting you from several different things. So it protects you from purchasing things when the prices are too high, for not purchasing something when the market is very, very low because you're emotionally connected to it and you think it may go lower, you think it may collapse. It protects you from the rumor mill around the coffee table and all sorts of other emotional based things. It also protects you from just being absent-minded and forgetting to purchase something and maybe missing out on the timing of it or trying to wait for the perfect timing. Number 5, run out what it'll look like for you long term. So let's take a look at an example. So if we take an example and we say we're going to invest $300 every pay period times 26 pay period is $7,800 in a year. In simple terms, if we run this out and we say that we invested that $7,800 a year into a S&P 500 index fund, we'll assume a rate of return of about 10%. After 10 years, it's about $150,000. After 20 years, it's about $350,000. And then after about 30 years of that, you're looking at $700,000 to $900,000. So dollar cost averaging is like our version of muscle memory. You do it and you set it up automatically so that you don't have to think about it. Same way we rep out things in the gym or rep out things at the while we're training. You do those things a million times and you don't have to think about it. You don't have to worry about them. And the benefit is that it pays you in the long term, right? You're training and repping things out. You're not thinking about forcing the door or cutting a hole. or pulling hose down the hallway and making a turn left or right. You're not having to think about that stuff. Dollar cost averaging works the same way through investments. You set it up automatically, and you have some basic things in there for you, like how you've diversified it, and that money is going to grow and compound over time. Let's go through some common questions. Is dollar cost averaging better than just investing in one big lump sum? Actually, one big lump sum is the better way to go if you can time it correctly. The hardest part we have for this is purchasing things when the market is completely down and having the emotional separation from it. Because of this, the consistency with dollar cost averaging tends to work out better for most people. So what if the market crashes while you're doing the dollar cost averaging? Well, that's good news for you, because that just means you're buying everything that you're purchasing normally at a discount. Should I change the amount I'm investing? Well, this shouldn't have to do anything with the market itself. It should have to do with your particular financial situation. So if you're in a spot where you've gotten a pay raise or you had to take a pay cut, maybe make some adjustments then. But I would encourage you to continue making the investments on a regular basis. Dollar cost averaging is a great way to remove emotion, stress, and worries out of the timing of investments. Set it and forget it, let the automation work for you, and let your money grow over time. Download the dollar cost averaging quick guide in the description below. Thanks for joining me on Finance for Firefighters. Thumbs up if you like it. Comments below. I'll see you folks on the next one. Hope you have a good shift.